first, I'll go through JP Morgan's earnings. It's always kind of an interesting report, not just because it starts off, that sort of sets the tone and tenor for financials, but obviously there's sort of, broader read-throughs across the macro landscape. So to set the stage a little bit, recall that it was like 6 weeks ago, right around the beginning of June, that Jamie Dimon basically came out and said, prepare for, an economic hurricane. His comments were really focused on sort of two or twin impacts, one being quantitative tightening, and, primarily in the US, but really globally. And then also the effect of the war on both oil and food prices. So, he said something along the lines of, right now he was kind of sticking with this weather metaphor. He was sort of saying, right now it's kind of sunny, things are doing fine. Everyone thinks the Fed can handle this. But that hurricane is right out there down the road coming our way. The numbers, they were okay. They were not good. They were certainly not great. So to run through it, they're definitely sort of tilting here, but I was, I guess, a little surprised that, the sort of how small the build was, kind of juxtaposing that against, Dimon's sort of, hurricane comments. So you ended up with net income down 28% year over year. So 8.6 billion in net income, down from 12 billion. Earnings down a similar amount per share, 27%. So 276 down from 378. But in this environment, as we've shown on the macro side, the reason there's so much loan growth has a lot to do with the fact that people have negative real earnings growth, negative real income growth, right? So for the last 15 months and counting, inflation has run, well in excess of income growth. And so people are basically making up for that by running up balances on their credit cards. And obviously that's very high cost debt, which, just servicing on that debt ultimately ends up putting people in, an even worse hole. So, it is generally consistent with his hurricane comments that things are sunny at the moment, but there is a massive storm brewing and heading this way. And I think, you don't really have to look much further than what the Treasury market did yesterday on the heels of that 9.1 print, which is a good segue here. So obviously we're, significantly inverted at this point. It's no longer subtle. On the 2s and 10s, it's like 25 basis points inverted. So, the bond market is clearly at this point signaling that the future growth outlook is getting worse at a accelerating pace.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.